aggressive cuts from Bank of Canada priced into the market, have fixed rates bottomed? Today we're going to be talking about how falling interest rates are affecting the housing market. Bank of Canada is cutting rates because the economy is slowing, unemployment rate is rising, and inflation is finally under control. But will these rate cuts actually help the market in the short term? Let's take a closer look at what the data is saying about variable and fixed rate mortgages and what's to come with rate cuts. Common sense would make you think lower rates, more buyers in the market. But what we're seeing is actually with lower rates, more sellers are coming to the market because with declining rates, they think it's a good time to list. In many markets over the last couple of years, you saw record low numbers of new listings, which has kept prices pretty elevated despite the drastic rate increase because of supply and demand. Now with lowering rates, those sellers who were holding off are now coming to the market. And in many markets, this excess supply is not met with the demand of buyers. The Bank of Canada is expected to cut interest rates about 200 basis points before the end of next year, which could bring the variable rate mortgages down to the mid to high 3%. Now, that's variable rate mortgages. As for fixed rate mortgages, most of these cuts are already priced in. This chart that we'll show from Desjardins research shows that the 5-year fixed rate mortgage has already dropped about 170 basis points from its peak. So while the variable rate will continue to fall as Bank of Canada continues to cut rates, the fixed rate really isn't expected to move that much, with most banks pricing in these cuts already. With banks offering these rates, fixed rates, in the low 4%, this could be pretty close to the bottom that we see. So why does this matter? Well, a lot of buyers and sellers think that because rates are coming down, fixed rate mortgages are coming down, but that's not the case. Variable rate mortgages are tied to the overnight rate. Fixed rate mortgages are tied to the bond yields. So with all of the media talking about rate cuts, most people don't opt to take a variable rate mortgage, especially in this environment when the variable rate is substantially higher than fixed rates being offered. Typically, buyers opt for fixed rate mortgages over variable rate mortgages, even though variable rate mortgages have historically outperformed fixed rate mortgages because fixed rate mortgages offer more peace of mind and more security. Now, as I said, fixed rate mortgages have already priced in these rate cuts as the bond yield hovers around 3%. So if you're looking to get a fixed rate mortgage and you're holding out for lower rates, you may be holding out for a longer time than you think. And if the Bank of Canada needs to cut more aggressively and bond yields drop even lower, we may have a bigger problem on our hands because the economy is probably not doing very well at all. That's it for this week's video. I thought it was an important topic to make a video on because I'm having daily conversations with people figuring out when the best time to list is. And the conversations go, well, rates will be lower in this time in the future, so is it a good time to wait and list until this time in the future? And you're talking about the Bank of Canada overnight rate, because if somebody's buying your property with a fixed rate, those cuts are already priced in. And this is a market, and markets are based on supply and demand. And that really trumps almost anything. If there's more supply than demand, prices will go down. If there's more demand than supply, prices will go up. And that is like any other market, and we're not unique from that. So thank you guys for watching this week's video. Stay tuned next week for a new video.